Welcome back to the deep dive. Today we're diving deep into the strategic mind of a major global financial powerhouse.
We are, and our source material, it's not just a boring list of results, it's the Q&A section from their 2025 Q4 earnings call.
Which is always where the real story is, right? It's where
Yep.
the analysts get to grill management and force them to, draw the map for the next few years.
Exactly. This isn't a backward-looking document. I mean, sure, they recap 2025, but the focus is squarely on the playbook for 2026 and beyond.
So for you, the listener, our mission is to pull out the core themes. We're looking at, I think, three big ones.
Three big ones. First, a really dramatic pivot in how they plan to scale wealth management. Second, this idea that they've set a new, higher structural floor for their returns.
And third, what they're calling a highly constructive outlook for capital markets. So we're going to give you that high-level understanding without all the jargon.
Let's do it.
Okay, let's unpack this immediately. Let's start with that big strategic pivot you mentioned in their wealth business.
Right. So the first thing management does is clarify what's working incredibly well. And that's the UHNW franchise,
Ultra high net worth.
ultra high net worth. They call this segment extraordinary. They have a leading position in the US, and they're offering services for clients with, very, very complex needs.
So the high-end, bespoke, white glove service is thriving.
Yeah.
But when they look at the broader market, that's where we see the big shift.
That's the pivot point. They've decided to move away from trying to provide that full-service wealth management directly to, let's say, the wider public.
And this is after what they called their experiment with United Capital.
Exactly. That experiment is over. They've concluded that trying to replicate that super specialized UHNW model for the mass affluent market just created organizational drag, complexity they just didn't need.
So what's the new path to scale?
The new path is through third-party wealth channels.
Which means they're leveraging other people's distribution networks.
Precisely. They are betting heavily, and I mean heavily, on partnerships with RIA's registered investment advisors.
So it's basically them saying, look, we have the best factory for financial products. You RIAs can handle the storefront and the client relationships.
That's the perfect analogy. They have a great product manufacturing capability, a complete diverse product offering. It lets them scale without this massive upfront investment in, say, new branches or thousands of new advisors.
It's a very capital-light way to get new clients.
Very. And the timing, as management pointed out, is perfect because this whole strategy benefits from these huge secular tailwinds.
Okay, like what?
Well, they explicitly mention the huge generational wealth transfer that's happening right now. Trillions of dollars moving to new hands.
Which naturally creates demand for advice and products.
Right. And crucially, the overall wealth market is still highly fragmented, so their RIA partners have plenty of room to grow, and the firm just grows right alongside them by supplying the best products.
It really sounds like a recognition that scaling in that middle market is a distribution game. It's not a product creation game for them.
It is, and they've put a clear metric on it, too. The long-term goal is to keep growing their fee-based wealth assets by at least 5% a year going forward.
So that gives you a very clear trajectory of what they expect.
Provides clarity and accountability.
Okay, let's pivot now from structural shifts in wealth to structural shifts in their core profitability. Analysts were really digging into durability.
They were. The question was, how much has the firm really raised the floor for returns?
Because historically, when market cycles turned south, their returns would often drift down into the low double digits.
And management's answer was that the floor has been raised meaningfully. And this isn't just wishful thinking. It's based on some fundamental changes in their business mix.
They're generating more of what they call durable revenues.
Mm-hmm.
What exactly are durable revenues in this context?
Think of them as recurring income streams. So fees from asset wealth management, financing income, things like that, rather than just the transactional revenue from, say, a big M&A deal.
So they're revenue streams that have a solid base, even if the capital markets slow down a bit.
Exactly. They're not totally immune, but they provide a much, much higher baseline of profitability.
And they put a number on that uplift, didn't they? The firm's returns used to average 9 and change % in the 10 years before their investor day.
Right. Now, they're saying their huge global banking and markets franchise should run mid-teens through the cycle.
That's a transformative change in what they expect their minimum performance to be.
Mid-teens is the new bar. It's a much higher expectation. And the biggest single driver of their confidence in hitting that sustainably higher floor, it came from the asset wealth management business, the AWM side.
Why is that AWM confidence such a game changer for the whole firm?
Because their confidence in the AWM margin went way up, they're now targeting a 30% margin for that business.
Which is a big structural improvement over what they expected before.
It is, and management was very clear. This margin expansion drives a higher return and just elevates the performance of the entire company. AWM is fee-based, it's durable, and if you can run that at a 30% margin, it just stabilizes everything.
Makes those mid-teen targets much more believable, even in a down year.
Much more achievable, yeah.
Okay, so that's the floor. Let's look up at the ceiling now. Or what management hopes is not the ceiling. The 2026 capital markets outlook.
This is the moment they got that classic "what inning are we in" question.
And the comparison point was 2021, which most people see as an absolute, historic peak for the market.
And this is where their conviction really came through. The firm insists that 2021 is not the ceiling long term. They're not promising they'll beat it next year, but their internal projections are, let's just say, highly aggressive.
How aggressive? Give us the numbers for M&A activity.
Okay, so their base case projection shows 2026 M&A activity landing pretty close to 2021.
Pretty close to the all-time peak.
And their bull case, their upside scenario, is actually ahead of 2021. They believe the world is incredibly constructive in 2026 for M&A and capital markets activity. It suggests there's massive pent-up demand.
So they think this cycle has a lot of runway left. They even said they are not yet in the middle of the potential for full-on M&A and sponsor cycle.
Which is a surprisingly bullish view given, interest rates and geopolitical uncertainty.
So why are they so confident? What are they seeing?
It comes down to tangible data. Their backlog. The backlog for their advisory business is the highest in 4 years.
And it's the 7th straight quarter of growth.
7th. That advisory activity is the engine. It's what they call the flywheel advisory, leads to financing, financing leads to capital markets activity, and so on. A deep backlog is a powerful predictor.
So let's break down the specific factors they see driving this upside. What are the macro ingredients here?
They identified what they called a powerful macro combination. So you have fiscal stimulus, monetary conditions, capital investment, and deregulatory sentiment all sort of aligning to create a good environment for deals.
A holistic view. Okay. Factor 2 was the IPO market. This is interesting because they said the IPO business is currently decidedly below the average level.
Exactly. It's a trough that's ready for a surge. They're expecting an acceleration driven by sponsor momentum, private equity firms needing to cash out, but more importantly, by these very, very large companies that have stayed private for a long time and are now finally looking to go public.
So the quality and size of the companies coming to market will be really strong.
That's the implication. But they did add a really important clarification about equity capital markets overall.
That it won't repeat the 2021 peak.
Crucially, yes. They expect total ECM to be meaningfully below the 2021 peak. The reason is the SPAC phenomenon.
Right. Special purpose acquisition companies.
That whole thing inflated 2021. It was a unique, often speculative rush. The growth they see coming is more from traditional, substantial IPOs.
That's a critical distinction to make.
Yeah.
Okay, and the third factor driving this M&A expectation was CEO sentiment about regulations.
Yeah, management said they've seen a real shift in the C-suite. CEOs are much more front-footed on scaled consolidation.
Meaning they're more willing to do big deals.
They believe a window is open right now for big, strategic, transformative things. And this view is shaped by a perception that the regulatory environment is more favorable for large deals than it has been in the last few years.
That insight on timing and regulatory reception is gold for anyone tracking corporate strategy. Okay, so let's talk about what they plan to do with all the capital this constructive outlook is going to generate.
On transformational M&A, their posture is still very, very conservative. The bar for any significant and transformational deal is set very, very high.
Why is that?
Cultural integration risk. Big deals are incredibly difficult to pull off. They much prefer smaller, targeted acquisitions like the recent Tro partnership to just fill in gaps and accelerate growth in key areas like AWM.
So it's about accretion through addition, not risky mega mergers.
You got it.
So if big deals are off the table and they're expecting a huge year, how do they get that capital back to shareholders?
Buybacks. Buybacks remain the most important tool here, given the excess capital they expect to generate. It supports their long-term goal of reducing the share count significantly and sustainably.
which drives earnings per share growth.
Right. But they did stress they'll be mindful of the price. They're going to be opportunistic, not just buying back shares at any price.
Okay, and beyond capital rules, you flagged a point about regulatory flexibility. They said changes over the last 5 years imposed a lot of costs and burdens.
And now they expect those costs to ease. That frees up internal capital that was previously tied up in compliance and, frankly, non-productive requirements,
So they can redirect that money into productive growth and return.
like funding the expansion of those new wealth advisors we talked about at the beginning. It all connects.
It does. Let's look at their financing business, which has become a much bigger piece of their trading revenue. It grew from under 20% 5 years ago to approaching that 40% threshold.
Yeah, and the evolution here is it's really about smart risk management. They want to use their asset management business.
How so?
Future financing growth will be focused on putting their origination flows into asset management products. So they're providing their clients with access to these high-quality credit assets.
Which lets them grow the business and generate fees without having to hold all those assets on their own balance sheet.
Exactly. It minimizes their regulatory capital requirements. It's a great way to grow without bulking up on systemic risk.
And what about on the private banking and lending side?
They still plan to grow lending and deposit activity, but they did flag one expected headwind:
Which is?
NIM compression, net interest margin. It just means the profit they make on the spread between what they earn on loans and pay on deposits is probably going to tighten as the Fed brings rates down.
A necessary headwind, but one they think they can manage through volume.
That's the plan.
All right, let's transition to our final segment, technology, because it really underpins this whole plan. Management was really specific about the role of AI in their Goldman Sachs 3.0 vision.
They were. And it's emphatically not about transforming the whole firm.
That's a crucial clarification.
It is. It's about driving productivity and efficiency in their core businesses. They talked about a dual focus. First, individual productivity. Just arming their already smart, productive people with AI models and tools to do more.
Which they argue is just an acceleration of what they've been doing for decades anyway.
Pretty much. But the second part, enterprise efficiency, this is where the real structural change happens. They're deploying tech to reimagine operating processes.
And create real efficiency across the whole enterprise.
And they were clear. Efficiency isn't just a code word for cutting headcount. It's about freeing up existing human capacity to then invest in growth.
So enabling teams to onboard more clients or freeing up money to hire more wealth advisors without blowing up the cost-to-income ratio.
Exactly. They said they're currently attacking 6 specific processes. We don't know exactly which ones, but you can infer they're high-volume repetitive functions, things like legal review or compliance intake that tie up highly paid people.
That focus on 6 specific, measurable targets shows they're actually operationalizing AI, not just, talking about it. And beyond their internal efficiency, they're also focused on emerging market structure innovation. What are the 2 external areas they're watching?
Okay, first is tokenization and stablecoins. They're really engaged in the discussions in Washington, even referencing potential legislation like the Clarity Act. They see these as important innovations.
But they're tempering expectations a bit.
A bit, yeah. They noted the pace of regulatory change might be slower than the market hype suggests.
And the second area they're watching?
Prediction markets. The firm's leadership has actually met with the leaders of the 2 major prediction companies.
And why does that matter to them?
Because these activities, especially the ones regulated by the CFTC, look and act a lot like derivative contracts. So they could cross directly into their existing global markets business. But again, they stressed it is still early on both.
They're positioning themselves to participate when things solidify, rather than leading that initial speculative phase.
That seems to be the strategy.
So let's bring it all back together for you. We've just walked through the 2026 playbook. We have the deliberate third-party expansion of wealth to gain scale.
The clear confidence in a sustainably higher floor for mid-teens returns, which is all driven by that durable revenue.
And that highly aggressive M&A and capital markets outlook for 2026, which is all supported by that massive advisory backlog.
Yeah, and I think the overarching strategic theme here is this sort of internal tension. They have to maximize efficiency using AI, hitting those targets in those 6 core processes, while at the same time using the capital they free up to aggressively invest in growth.
They have to execute both sides of that equation perfectly.
They do.
Which brings us to our final provocative thought for you to consider. Management talked about their long-term ability to accelerate revenues per employee over the next 5 years, all thanks to AI integration. So given the forecast for a very, very good year in capital markets, which will probably deliver high returns regardless of efficiency, is the true measure of their success in 2026 found just in the absolute returns? Or is it something deeper? Is it about how effectively they translate those first AI efficiencies into sustained, profitable capacity for growth in the years that follow?
In other words, are they building a permanent runway or are they just having another good cycle?
That's the question. The firm's ability to show discipline on expenses while chasing growth will determine if this really is a structurally higher floor or just another cyclical peak.
And that is the ultimate test.
A huge thank you for joining us on this deep dive. We hope you feel thoroughly informed and ready to think critically about this major firm's trajectory. We'll see you next time.